the heck just happened to the stock of Domino's Pizza? This morning, the gigantic pizza chain reported it was widely perceived as a disappointing quarter. That's the second serious disappointment this year. Stock got pummeled today, down $23 and change, or nearly 9% response. But when you drill down, you have to wonder if maybe the market's overreacting here. Wall Street freaked out over the domestic same-store sales. They were up just 3% when people were looking for 4.6%. At the same time, the total revenue came in a bit light, up to 5.1% for the year. The year-over-year number, I expected better there. I did. On the other hand, though, Domino's did deliver excellent earnings, $2.19 per share. Wall Street was only expecting $2.02. Hey, maybe the revenue growth was slower, but that growth is more profitable. Nobody cared about the earnings beat today, though. The sellers were all focused on the same-store sales. So has this stock become too tough to own, or is the company simply going through an adjustment period that you simply need to wait out? Let's take a closer look with Ritch, Allison, the CEO of Domino's Pizza, to learn more about the quarter and where his company's headed. Mr. Allison, welcome back to Mad Money.
Hi, Jim. Thanks for having me on the show.
All right, Rich, we all know the stock was down $23. What I like to do when I see something like that is to give the floor to the CEO to say why you can get that money back and then some if you play the long game with Domino's.
You know, Jim, when you take a look at our business, we still gained a significant amount of market share in the pizza category during the second quarter. Our retail sales were up 6.8%, which is significantly higher than the growth in the category and, frankly, much higher than the growth in the restaurant industry in general. So while same-store sales at 3% was at the lower end of our long-term outlook, the overall retail sales growth, driven by the combination of that same-store sales and really strong unit growth, was still quite positive.
Okay, so Rich, though, but throughout the discussion in the conference call, there was a lot of talk about these third-party aggregators, the pressure they're putting on it. There are labor pressures that are definitely a problem. There's some discounting going on. Domino's Pizza remains a great value, but it made me think that perhaps something structural has changed in the U.S. that could make it tougher to get back to that more of the mid-range or to the 6% that you really like to hit.
We know, Jim, it is a tougher operating environment than it has been in years past. We do have new competition in the marketplace that we're fighting against every day. And there are labor pressures in the marketplace. Certainly the tight employment environment and some of the rising minimum wages across the country are putting some pressure on. But we are really in a position of strength as we enter into this more turbulent period. 2018, our average store in the U.S. had operating cash flow as measured by EBITDA of $141,000. So our franchisees are very healthy. Cash-on-cash returns in the business are really strong. And I think that's why when you take a look at what's going on with units, we opened 45 units in the second quarter in the U.S. and only closed 3. It's still a very healthy business model, and I think we're positioned quite well as we look forward relative to the rest of the restaurant industry to continue to be successful.
All right, well, how about the international markets, where you did say that there are some near-term challenges for comps that continue? What can make those turn around?
Well, Jim, we're working hand in hand with our master franchisees around the world. As you look from market to market, the issues in markets can be different, depending upon those specific circumstances. But what we're trying to do is work with the markets to bring some of the same terrific data-driven decision-making that we've used to grow the business in the U.S. over a number of years now and help our international markets in that regard. But, broadly, you take a look at the international business, retail sales up 9.8% in the second quarter. So gaining share at a significant pace in the international markets as well. Great growth in the international markets this past quarter with 158 net store openings. So it remains a very healthy business despite the comps over the last few quarters being, on the lower end.
All right, well, Rich, let's go back to this third-party aggregator. I know I talked to all of them. I talked to DoorDash. I talked to Postmates. I talked to GrubHub. And what I continue to find is they may want to be in this business. They charge the actual company a fortune, sometimes 25, sometimes 30%. Why do they represent a real challenge, given the fact that it's difficult for your competitors to not have to raise price dramatically and make Domino's much cheaper?
Yeah, I think part of what we're going to see here in the near term is that there's so much investor subsidy into that business model right now, we're not really sure where it's going to shake out long term because there's substantial discounting and overinvestment in advertising right now to drive consumer demand. We don't know how that's going to shake out once consumers actually have to pay the full cost of that delivery because those fees are quite substantial relative to the cost of the underlying food. I think we also have not yet seen what's going to happen with the supply of restaurants on these platforms as well. You know, over time, it'll be proven out whether or not that business is truly incremental and whether or not that business is actually accretive from a margin standpoint, you know, to the operators that are offering that service through the third-party aggregators.
Well,
so
you're the first
long-term,
person,
still a lot of questions, but short-term, you know, certainly some pressure.
You're the first person to say on air exactly where I was going, which is that they're playing with free money, Rich, these aggregators. They are hard to beat because the stock market is ready to finance them. That's who you're up against. I think that's transient. That's why I think that Domino's can come back. This is really, yes, we can't create more people. We're pretty near maxed out on what technology can do. But you are in an unnatural war with players that are being subsidized by us in the stock market.
Yeah, and we're not going to do foolish things, you know, in the short term in reaction. You know, Jim, we're still very focused on our franchisees' profitability. That's first and foremost in our minds. And still very focused on generating great returns and free cash flow for our investors. You know, we're generating cash flow now at a pace of about $1 million a day in the Domino's business. So, you know, some near-term activity here that's creating some turbulence in the marketplace, but we're going to remain focused on our long-term strategy, great profitability for our franchisees, and strong operating cash flow and returns for our investors.
Last question. I do not hear you say, look, this is the new norm. We're adjusting our rate from 3 to 6, to 1 to 3, or 3 to 4. You're not doing any of that. You're sticking by your targets, and you think you can go back to where you were.
No change to our outlook on same-store sales, store growth, or retail sales growth.
All right. Do you mind if we hold you to it?
Thanks, Jim.
All right. Thank you to Ritch, Allison, CEO of Domino's. Look, when they're down 23, you don't look for another reason to be down 23. You take a look and see maybe it's the right thing to buy. You decide. I still like the pizza a lot. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.